Welcome, everyone. Last week, it seemed like every corner of the market was telling a different story. Oil prices had held steady despite tensions, while the Fed kept rates unchanged, leaving traders stuck between inflation fears and recession risks. We'll hopefully help a little in this new episode of All Access. I'm Yoli, head of marketing at Deriv, and with me, as always, is Prakash Bhudia, our head of trading and growth. Welcome, Prakash.
Thank you, Yoli.
So, last week you said that even though inflation in the US is cooling, rate cuts are not guaranteed. And Powell proved you right as the Fed held rates steady at 4.25 to 4.5 again, while markets were hoping for a summer cut. What does this decision say about the Fed's confidence in current conditions?
So I think Powell has basically left the door open, but the markets have got the message. So this is a data trap. If inflation doesn't fall further, or if we see energy and the tariffs, we get a re-escalation there, then essentially it looks like the Fed could stay sidelined well into Q4. And that's now what we're starting to see, right? So we earlier on in the year, we had 3 cuts being priced in. Now it's 2. And the way the market now seems to be drifting is towards pricing out the cuts. And soon we may be down to 1 or even none. So that shift is already starting to move the front end yields higher. And in my opinion, right, the way we're going, we could essentially have the situation of these 2 cuts being priced out at some point over the next few months. And if that happens, then we could see the entire cross asset map, sort of repricing. You could now start seeing the dollar staying firmer. Depending on the rate sensitivity with gold, we could see maybe even pressure on gold. We could see tech under pressure. So there's...
we also saw the Bank of England that also chose to hold, but hinted at cuts possibly maybe beginning in August. So there's 2 central banks, one shared dilemma. Are we seeing like some sort of mutual hesitation or diverging priorities among global policymakers?
So the BOE, it's interesting because they might be doing more than what's necessary. So they're probably more dovish than the market's expecting. They're walking that line between ready to pivot if growth and inflation starts to cool as expected. So while it's the same caution with the Fed, it's interesting that the BOE in this case is much ahead of the Fed. While we do see that the UK economy might be cooling faster, it is interesting to see the BOE positioning a bit more dovish.
So what do you think, what should we expect from the ECB's meeting?
So ECB, we still have another month until the meeting next in July. The tone will be crucial. So they've already cut once earlier this month, and the market's essentially looking for a signal on what will come next. The key here is credibility. So if Lagarde hints that June was a data-dependent pause, or after the June cut, we could see a pause, then we could see the euro strengthening. So if she starts leaning too dovish, right, this may put some pressure. Inflation remains uneven. It's stronger in France and Spain, but weaker in Germany and Italy. So while the markets are pricing in one additional cut by the year end, um, we're not seeing the markets, kind of begging for it. I think what's necessary is, clarity and consistency. And I think, yeah, one cut at the end of the day, it's not a big amount priced in. So I think it's interesting. If anything, we could again, if we see pauses in the BOE and the Fed, we could see this one cut being priced out as well.
So switching to equities, Palantir is up nearly 90% this year, and IBM is riding the AI wave too. They've both become big names in the AI stock rally. But with prices climbing so fast, are they starting to look overvalued? Or is this just a short break before the next move?
That's an interesting question. So, as you said, Palantir has had a phenomenal
Yeah.
run. But if you look at the technicals and the fundamentals, it's starting to show fatigue over the last couple of weeks. It's underperformed its other AI peers. If you look at some of the technicals, valuations look stretched versus the 50-day moving average. So it shows that the stock is technically extended, while the momentum is not overbought. It does show signs of slowing. And we've seen key levels close to $142 tested a few times, and we haven't the stock price hasn't managed to break through. So it's signaling that some consolidation is needed, or some further catalysts for further upside. Um, so I
So
think
you do think that it's potentially taking a little bit of a break, or
yes.
if people are not in it, should they be looking for dip opportunities, or is it likely that there's going to be consolidation for a while before the next move?
So I think look for support near 100 and $125.
Okay.
So the um, the RSI is actually quite neutral. So as mentioned, it doesn't, even though the momentum doesn't look overbought, but it is slowing. So there needs to be a bigger catalyst. So I think any dip towards 125 is a good buy zone.
We spoke about Nvidia a couple of weeks ago, how they recorded a 44 billion in revenue, nearly 70% up year over year. But the stock didn't exactly explode. Why isn't the market reacting more strongly to their results like Palantir and IBM?
Yeah, so I think in the case of Nvidia, the market's already pricing in
Mm.
perfection. So what I mean by this is it's pricing in, perfect news, and even though we're seeing huge revenues and huge year on year growth, um, it doesn't guarantee that a beat in earnings will see a breakout. And if you add to that, add to the macro pressure and other volatilities and the US China chip export concerns, so you've got some reasons for investors to pause. So we need more. Again, it's a case where we need um, some news, some bigger news, which is even a bigger tail, over and above what the market's pricing in. So I think essentially some positive headlines could trigger another 5 to 10% move. Otherwise, we are seeing a pause.
So we're also seeing gold is hovering kind of between 33 100 and 3,400. It's surprisingly stable despite all that's going on in the world. So is it playing dead or is it saving its strength for what's coming next?
So I think the story, the balance sheet story is still there. You see central banks are still buying. Inflation isn't dead. We still have the geopolitical overhang. So we're seeing this tight range, but I don't necessarily think it's indecision. I think, this kind of compression usually at some point leads to expansion. So I think the reason it feels a little quiet is because gold is stuck between two forces. So on the one hand, you have the rising geopolitical risks and
Hmm.
sticky real yields. Um, and you, on the other hand, you also have the Fed holding the dollar staying firm, and what could possibly come round is the cuts being priced out, which could pressure gold. So you have these two opposing forces. So with that, the recent range has been quite tight.
And oil seems to consolidate between $72 and 75, while natural gas is showing a little bit more action, but things definitely escalated quickly as we've all seen. And it now seems like a supply chain disruption is becoming more likely. Are traders responding to this uncertainty by waiting for actual effects on the energy markets?
So this is very interesting, especially given the news over the weekend. We had
Yeah.
Brent spiking higher on the open this morning, and it got faded almost immediately. So traders know that there can be kind of tension and uh, talks of disruption, and so right now, for example, there's a lot of tension on whether the Strait of Hormuz could be closed, but this in a way is self-defeating, since Iran itself depends on that waterway for
But
export.
if we saw an actual closure or at least some sort of disruption in the movement of shipments in the Gulf, which economies would feel the pain first? In other words, should we go long or short of this closure?
Because the first wave of pressure will hit Asia's big oil importers. So the biggest is China, India, Japan, South Korea. They rely heavily on crude, Gulf crude. So any kind of rerouting or stoppage would squeeze them hard. India, in particular, it seems records show they have a very thin buffer capacity, and high fuel sensitivity. And China would also lose its access to discounted Iranian barrels. And therefore then have to compete with more expensive flows. So, from a trading perspective, um, you can do a lot more, right? You can do a lot more than just, for example, buying oil. You can also target the transmission points where the shock could get priced the fastest. So of course, if you are expecting an escalation, of course, Brent um, Brent and the wider oil complex, you can go long. But of course, we've seen in the volatile moves just today, we've seen up and down moves of 4 or 5%, and now Brent is actually lower on the day relative to Friday's close. So you
And
do,
just
yeah.
just a reminder for the folks who've been following, you mentioned this before. So, when we were talking earlier, you seemed skeptical that we will see a closure. If that's the case, then what's the trade?
Well, if we do see a closure, then you essentially have a number of trades you can do. So, firstly, of course, is just exposure to oil itself, which is
Mhm.
likely to spike higher. Secondly, you could do it as a spread, either a calendar spread, or you could buy Brent over WTI, where you'd expect the risk premium on that to widen. You can buy oil tanker stocks, so like a few frontline Euronav, TK. So we're likely to see the day rates of tankers surging. These companies have already gone up quite a lot over the last few months, but we could, if we see another rise in insurance premiums, rerouting extends delivery times, so we could see these companies benefit. We also have some transmission through Forex as well. Canada is an oil producing nation.
Mm.
So being long Canadian dollar versus a weaker emerging a Forex pair like an INR, which, India, who could feel quite a big impact, would be an interesting trade as well. So through FX, so long Canadian dollar versus INR, or even versus Japanese yen, particularly if oil can stay above 80. We could see gold moving higher.
Mm.
If you want to play from the short side, airlines, logistic companies could get hit with a rising oil price because of reducing margins because of rising fuel costs. And so even a 5 to 10% spike in oil can cut the quarterly guidance of many airline companies. Um, and like I said, the emerging markets, FX, INR,
Yeah.
PHP, IDR, all could suffer some contagion. EM equities, so given what we've just discussed about India, equities could weaken or underperform. Broader Asian markets could see outflows. So there's
Well,
a lot of different trades. Yeah.
things to watch. Well, traders, there you have it. That's all we have time for today. Thank you for watching the show. Don't forget to hit the subscribe button, and we will see you next week for another update on the markets. Thank you, Prakash.
Thank you.